Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. What we've been talking about the last couple weeks, and we'll be talking about the next couple weeks, and maybe even the next year or so, obviously, will be the new Trump tax proposed plan that passed the House, is in the Senate. There's a lot of debate about which components of the plan are to continue, which components of the plan will lose, and which will be modified. So we don't even know if a tax proposed plan will be approved, come into effect, and become tax law, or whether or not, like some of the healthcare provisions that have been proposed and not passed. So we don't want to go overboard on our planning, but we do want to be aware, especially since it's end of the year. The reason, especially this year, is if any portions of this tax proposal go through, some of the proposed changes will be benefits that we have this year that will be lost forever. So we want to be a little bit careful. Should we maybe double up on some deductions this year that we may not be able to take anymore after next year? And also there are some benefits that are coming in that we don't currently enjoy. And the strategy there might be, especially since we're near year end, should we wait to do certain actions until after the first of the year? So let me share with you, I want to go through a lot of different areas. Since we're at year end, the first thing I want to merge with this tax discussion, we have traditional year end tax strategies, even if there was no proposed law change, that I want you to be aware of and take advantage of. So what I really want to do in today's show, and really over the next couple shows, is help you become aware of many tax saving strategies that you may or may not be aware of. In doing so, I don't need to teach you about them as much as make you aware of them, I think, to turn light bulbs on as you're listening in the car right now, or as you're watching my videos that you're getting through the emails or on YouTube. I want you to stop and think about and have note paper, if nearby, to be able to say, hey, a light bulb went off. Should I check into this? Should I check into that? For example, let's say we're in a situation where you might want to contribute and you're not sure whether to contribute to an IRA, a Roth IRA, maybe max out or ramp up a final year contribution to your company 401k? Should you contribute to health savings accounts? And these are conflicting decisions sometimes. Then we get into gifting. Should we gift money to our kids before the end of the year? And if we do, should we split gifts and all this? So, and I get into other situations, and so will you. Some of you are considering, should we donate to charities? And year-end charities, should we donate cash? Should we donate stock? Should we split those gifts? Are we going to be able to write those off? Are we going to lose them under the new tax proposal? All these and more. Will we be able to deduct our long-term health care expenses? So in the new, let's get into this new tax proposal first off. What benefits we have, I went over the last couple weeks. We may lose our health care write-offs. We may lose our property tax write-offs. So on our itemized deductions that some of us take and standard deductions that others of us take when we prepare our tax returns are all going to change. So the one thing I can tell you is everybody's tax return will be changed if this new tax proposal goes through as it's proposed right now, currently proposed. One of the changes is called tax simplification, but it summarizes tax simplification by let's raise the standard deduction limit, let's get rid of the personal exemptions. Let's get rid of the property tax deduction. Let's get rid of the medical expenses. Let's get rid of most itemized expenses and only keep, for the large part, some child care expense, some mortgage interest expense still be allowed to be deducted, and charitable deduction expenses. And all the rest, let's throw them out. And that's called, under this proposed plan, tax simplification. So the problem is tax simplification for some of you might be expensive. It might be, okay, now it's simple. I lost my write-offs. I owe more in taxes. Nice job, folks. And for others, it might be, well, we didn't itemize anyway. So now they raised the standard deduction. So it just increased our deductions because we weren't taking itemized anyway. Every one of you listening are different. And thirdly, you get the real estate investors who can deduct property taxes maybe on your Schedule E for your business real estate, and these are only affecting your personal residence. So you'll see some investors do different things. They'll turn their personal residence into a business, and the corporate tax rate is coming down. And on service industries, there's a fear from the Senate saying we want to protect against service companies, self-employed individuals, forming a corporation just to benefit by these hypothetically lower corporate tax rates than you would have on a regular individual tax rates. So you'll see all kind of chess pieces, pawns moving around the board on this before the rules change and also after. What we're interested in right now is between now and the end of this year. We are pre-planning into 2018, and we are post-planning, I'll say, near the end of this year in 2017 to maximize what is known at this point. One thing that is known at this point is you're allowed to gift money. Another thing that's known about this is you're allowed to itemize charitable deductions. You're allowed to itemize long-term care expenses as medical expenses if you itemize. You're allowed to itemize medical expenses. You're allowed to itemize your mortgage interest that's paid, and you're allowed to itemize your property taxes. So, and others, unreimbursed employee expenses and things like that. So let's go into this. The first thing when we look at, we're looking at goals. And our goals for when we get near year end are, let's talk about charities first. We want to give money to a charity or a number of charities. So the first question that usually happens is, where do I write the check? Sometimes the second question is it tax deductible? For the most part, the charity has to be set up as a bona fide nonprofit organization under Section 501c3 of the Internal Revenue Code. So if they do not meet that test, that's churches and things like that, if they do not meet that test, you may be disqualified from the income tax deduction for a charitable contribution. So know that first. And that's under the current rules. So let's say you choose to say, okay, where do I write my check? So your second question is it tax deductible? Let's say it passes the test and it's tax deductible because it's to a bona fide charity. Third is, okay, fine, you write the check out and you send it. Now, me as a financial planner, I'm going to back you up. I'm going to say, wait a minute. You just wrote a check, which means the money was in your checking account. And then I'm going to ask, do you keep that much money in the checking account typically, or did you put it as a deposit into the checking account from somewhere else in order to fund this contribution? And if you say, yeah, I made a deposit to put it in here, my question is going to be, where did the money come from? You might say your savings account. You might say your mutual fund accounts. You might say your IRA accounts. You might say your 401k. You cashed out. You might say your stocks or your bonds that weren't in IRAs. You might say, I just had money laying around, or I sold a property, or I had an inheritance. Wherever you say it came from, it matters. It's a completely different situation, mathematical equation. What do I mean? You sold, let's say the money came from mutual funds. Let's say you're getting a 1099 at the end of the year for capital gains for those mutual funds. There's a strategy you could have employed, that you could have donated shares of the mutual fund rather than selling the mutual fund and taking the cash. You have $1,000 in a mutual fund, or you have $1,000 in a stock, and you choose to cash it in. What you're stuck with is the penalty, actually, of cashing it in if they were appreciated in value over what you initially paid. That's called a capital gain. Before you sell and actually realize the gain or the loss or get the proceeds from the sale, it's called an unrealized gain, capital gain, or an unrealized loss or capital loss. But the minute you pull the trigger and say sell, send me a check, it's now a realized capital gain or loss. And now you can't reverse that. It's going on your tax return. They will 1099 you for either a minus if it was a loss or a plus if it was a gain. In either case, that's sometimes not the most efficient way to get money to charities. So if that's where the money came from, I would say, call our office, let's review the assets. Where's the most efficient source from which to take the proceeds where you want to donate to a charity? If you have a share of stock or a number of shares of that stock, we might suggest you consider the possibility of donating the stock to the charity instead of writing a check to the charity. Why? Because a 501c3 bona fide nonprofit organization can receive stock where you might have a capital gain of, let's say, $150. Could be anything on $1,000. Let's say it's $150. If you sell $1,000 worth of shares and you have a capital gain of $150, you owe tax on that $150, right? Everything over what you paid, if it's not in a qualified account like an IRA. So it's a long-term capital gain or a short-term capital gain. I won't go into details, but it's a capital gain. So what you're running into is if you donate that same shares of stock equal to that same amount directly to the charitable institution, and then they receive the shares, once they liquidate the shares, nonprofits don't pay income tax. They get to keep the whole $1,000, where you only had $850 or $950 left, whatever, after taxes. So whatever your tax rate is, if it's 33%, 39.6%, it's even worse. You have $1,000 not of stock this time, but let's say you have $1,000 of gain in a stock portfolio worth, I don't know, $1,500. Let's say you initially paid $500, now it's worth $1,500. That's a $1,000 gain. If you're in a high tax bracket, 39.6, you lose almost $400. The charity loses that $400 because you couldn't get it to them. But if you gift them the stock and let them sell it, they get to keep the whole $1,500. So there's strategy one, why we backtrack. Where did that money come from? Number two, it came from an IRA. Well, hey, then I get to what's your age. If you're over 70 and a half or if you're under 70 and a half. If it came from an IRA and you're over 70 and a half, you might be telling me, well, they're my required minimum distributions. And I took my required minimum distribution and then I figured I'd give it to the charity. And I'll say, well, did you take the required minimum distribution and write the charity the check for the same exact amount? And a lot of times people will say yes, and sometimes people will say no, because the RMD, the required minimum distribution, when it was sent from the company, we had the company, they'll tell me, deduct and withhold the taxes. They might withhold 20% of the check. So let's say your check was $5,000. The company institution withheld $1,000, which is 20%, and you have $4,000 check that you received. So you're donating to the charity $4,000. If you're over 70 and a half, there's a provision in the tax code, and you have to check with your CPAs to make sure this is valid for you, that you could actually direct your RMD, actually up to $100,000, directly from an IRA to a charity and have it count toward your RMD. There are advantages and disadvantages for that. Is it better to take the income, then donate to a charity, and take the tax deduction on your itemization on your return? Or is it better off to donate the whole amount to the charity and not have an income that you have there, but also not have the tax deduction? So you have to factor that in. You have to have a CPA work that out both ways for you. But without me telling it to you, you might not realize there's a difference, or even that you had a choice. So that's number two. Again, you can see when we go through this process, when you're writing a check out to charities, a good financial planner is going to go backwards and back you up and go back through the steps of where did that money originate from. Now, let's say we're looking at you're looking at benefiting a charity, but you want to leverage the benefit to the charity. What do I mean by that? Let's say you're taking required minimum distributions every year. And let's say your required minimum distributions are $8,000 a year, which they might be on $1.5 million liability IRA, let's say, the liability for the RMDs every year. So let's say $8,000 a year. And your income tax bracket, because that $8,000 a year is hurting you, your income tax bracket is going up because you are forced to take these RMDs, right? So we're near year-end tax planning here, and we're trying to figure out what to do. Whether you get your RMD in February or whether you take it in December, we want to figure out here, if you're taking your RMDs and then donating them to a charity, you do get an itemized write-off, and the charity gets the net difference, you know, after the taxes were taken out. Some people say, you know what, I want to take the RMDs and I actually want to create an amount of leverage with that. And here's what I mean. They'll say if they're healthy, they might be 65 years old or 70 years old and healthy, and they'll say, how much life insurance would $5,000 a year buy me? Interesting question, right? Because they're thinking, I don't want the RMDs. They're forcing me to take them. I'm just going to reinvest them in the markets anyway, they might say. What else can I do? Should I consider buying a life insurance policy for a charity? Did you get that? Buying a life insurance policy, not for you, not for your family, for a charity. Saying, wow, so I was going to donate the RMD every year to a charity. Do you mean I can leverage or max up the amount of the benefit of the gift by, even though the charity would have to wait for it until I died, instead of getting $5,000 a year or $6,000 a year or whatever out of my $8,000 after taxes? Are you saying that I might be able to get this charity a couple $100,000? Would $5,000 a year maybe buy that much? Well, that's the question. And sometimes it does. If your health is good and if you do the math and you structure it according to your own arrangements and your own plans, you may find that even $5,000 a year over 20 years might be, if you live that long, might be $200,000 or so. But $5,000 a year into a life insurance plan might pay the charity $300,000 or $350,000, and they get it all at once. So if you pass away even after the first year, the initial investment of only $5,000, leverage that gift up to $300,000 or $250,000. You see where I'm going here? So the benefit to a charity, potential benefit, without taking much from your family. Some people will list the charity on their beneficiaries on their family's life insurance. So they'll say 80% to my family, 20% to a charity or whatever. This sometimes is a better way to utilize required minimum distributions. Well, here's another one. And again, we're near tax end of this year. A lot of you have heard me say before about an IRA and converting an IRA to a Roth IRA, converting a traditional tax-deductible and tax-deferred IRA to a Roth IRA. Now, the Roth IRA, as you remember, we can put up to $5,500 a year into a Roth IRA until we're age 50, and when we can then increase that annual contribution limit to $6,500 a year, as long as we don't make too much money, because there are income thresholds on this. So what happens is a lot of high income earners are precluded and really eliminated from the Roth IRA world. Remember, the Roth IRA, the amount put into and contributed into the Roth IRA is not deductible from your income taxes. The amount originally contributed into your traditional IRA is a current income tax deduction. In a traditional IRA, all the gains all along the years for all the future growth on that original investment is tax deferred. You're not taxed on that all along the way. So the money you'd be paying the government every year on the gains is postponed. And that money that would have been lost to the IRS because you're writing a check is staying invested. So you're earning earnings on top of their share in addition to earnings on top of your share. All along the way, that snowballs and builds to quite a large amount. And you cannot access that money in a traditional IRA until you attain age 59 and a half, and then you're allowed to get access to the money without penalty. Now, a lot of people think mistakenly that means I can get at the money and not have to pay tax. That's incorrect. What is correct is if you take money out of a traditional IRA prior to age 59 and a half and do not meet one of the hardship provisions, one of the hardship exceptions, and you withdraw money, that is a taxable event and an event subject to penalty based on the amount that you took prior to age 59 and a half. I have a $100,000 IRA, I take $8,000 out. The tax and penalty applies only to the $8,000. Now, I'm 59 and a half. I no longer have a penalty on that $8,000, but I still have the tax at my whatever my tax rate is at 59 and a half or 60 years old. Okay, now, age 70 and a half, I still haven't taken any distributions from my IRA, my traditional IRA. Is it still growing tax deferred? Is it still growing tax deferred? Yes. At 70 and a half, the IRS says you have to start pulling that money out. You don't have to take it all at once, but you have to start taking it out at required minimum distributions based on your remaining life expectancy tables. So you say, I'm being forced to take money out of it, and guess what? That $8,000 a year that I used earlier is now taxable income on my tax return, forcing my Social Security and other income to be taxed at a higher rate now. It's forcing my Social Security to be taxed at 85% of my Social Security base rather than 50%. Or 50% of my Social Security is now taxed where none of it was. Or it knocked me off PACE. Or it knocked me off some other programs. I was perfect until they forced that money out. Now we look at strategies such as converting a traditional IRA to a Roth IRA. Now remember, I said we can't put money into a Roth IRA if you earn too much. The limit's 100, I don't actually remember what they are. I can look them up now. But 110, 130,000, I did not look them up before the show. But you get past that threshold, you can no longer contribute to a Roth IRA. So you can't have a Roth IRA. But those people that do have Roth IRAs all those same years never took the initial tax deduction. But then, at age 59 and a half, because they also have to wait until they're 59 and a half, or at least 5 years if they start late, the longer of the two, or they'll owe penalty on their earnings and their gains, it will otherwise be taxable. But otherwise, the Roth IRA is totally tax-free. the amount you put into it, and all those gains over all those years. So if you start with the exact same amount of contributions into a traditional IRA versus a Roth IRA every single year, you will have exactly the same amount at 70 and a half. And if that is indeed the case, which would you rather have? A tax-free pot of money or a fully taxable pot of money, both worth $1 million, let's say? Well, obviously, we'd say the tax-free amount of money. Well, in order to get that, we had to trade off the tax deductions all along the way. And believe me, when you're 70 and a half, and I ask you the question, was it worth it? The trade-off of losing the tax deductions all along the way? You'll say, oh, yes, indeed it was, because I now have $1 million and it's all tax-free. I can do whatever I want, whenever I want, and it doesn't affect my Social Security or any other income. Doesn't knock any of my programs out. I'm perfect. Any amount of money. It does factor into some calculations on the tax return, so we do have to be a little careful because there is line 8B for tax free distributions, and we have to be a little careful because municipal bonds interest ends up there too. Even though it's not in itself taxable, it can factor into other sources, so we have to do strategic planning there. So now for all you high net worth people, what does this mean to us? For all the regular people, you can contribute directly and build your Roth IRAs. But for all you high net worth people, everything I just said you're ineligible for, except for one thing. Remember, I started this conversation with IRA conversion. You can convert your IRAs, traditional taxable IRAs, into a Roth IRA without contribution limits and without income thresholds. What does that mean? That means no matter how much you make, you can end up switching your traditional IRA, shaking it out and converting it all into a Roth. You think it's painful? Oh yeah, because when you convert, what that means is, it doesn't mean cashing out the IRA and then reinvesting it into the Roth. But it does mean on any money you directly roll from a traditional IRA directly rolled into a Roth IRA is taxed as if you cashed it out. That is huge. So you're taking a horrible hit. Let's say 39.6%. 40% of your IRA is lost if you lump summed it all over and you're in the maximum bracket. What if you're in the 15% bracket? Well, you might say, I just want to slide pieces over every year, maintaining a 15% bracket. I don't mind paying 15%, you might say, because I'm going to pay it anyway once I'm 70 and a half. So you can do an IRA conversion. We have to be very careful here because there are stretch IRAs, stretch Roths. You know, you look at a Roth, it's automatically stretched. You look at a traditional IRA, it's stretched. You look at all these different issues, and there are also limitations that are proposed under the new tax proposal. Whether they fly or not, I don't know. But the stretch IRA has been talked about. Okay, if someone dies with a $5 million IRA, their kids can inherit it and receive it over their whole life, not pay taxes up front, and be able to stretch the tax proceeds and the withdrawals out over their whole life expectancy. Now, when I come back next week, because I'm out of time, I'm going to get into more of this strategy with IRAs near year end on benefits we may lose next year and have to take advantage of before December 31st of this year. All right, folks, thanks again for tuning in to another edition of All Things Financial. We'll be right back.